Hello and welcome to Business Television India. I am Piyush and you're watching The Market Guru. Joining us on the show today is Dipen, the Head of Institutional Research at HDFC Securities. Dipen, welcome to the show. Now, first up, let me ask you, at present, the benchmark index basically is now, in fact, if I'm talking about Nifty here, we are moving or we are nearing 12,000, again another 200 points to go. If I'm taking a look at the mid-cap index, again, there has been some recovery, but if I recall from January, again, we are still basically trading at lower levels here. If I take a look at the small caps, again, a similar sort of observation here. Now, in terms of flows, there is a sort of a difference, a divergence, which continues to persist between FI and domestic inflows. So the question to you is that what's your own take, your assessment about the quality of inflows, both on FI and domestic side, and how is it related to the markets at present?
So given the crack that played out after the end of January with the long-term capital gains tax coming in the budget proposals and the general pessimism that was seen after the budget, I think we've seen a remarkably strong rally, and while 11,000 was foreseeable, I must confess that 11,700 on the Nifty has certainly been a bit of a surprise. Now, I think there are two or three factors which have contributed to this. One is that domestic flows are very strong and very persistent. So we are obviously seeing the financialization of savings, the formalization of the economy, and close to $1 billion or so of SIP inflows into mutual funds every single month. This is unprecedented. And I can tell you it is actually the domestic investors, the domestic institutional investors, fueled by savings from domestic retail savers, as is visible from the SIPs. This is the factor that has really kept the markets going up and up and up, way beyond what you and I would have thought at the end of January or in the lows of Feb, for example. Will we hit 12,000 is the natural question to ask. Well, the momentum is very strong, but I do see several, external factors, global headwinds, whether it's trade wars playing out globally or whether it's the strengthening dollar, rising oil prices and so on. So it's a very interesting time to see whether domestic optimism continues. We've had very good headline print on macro news over the last few days. 8.2% is a stupendous number, despite adjusting for the low base and whatever seasonal adjustments you might want to make. So I think this is a very good time to perhaps reflect on whether 12,000 is just around the corner or not.
Dipen, coming back to you, as I was just talking about the eminent product here, flows again we have talked about. Now the second question here is that moving towards elections, the political elections, general elections, there are a couple of state elections also, but I'm just taking a broader picture here, broader outlook here. Almost 6 to 7 months to go again for the general elections after 5 years. What's your own sense of observation at present, or your own sense that are these flows, strong domestic inflows, they are going to persist primarily because SIPs are going to are fueling at present the domestic inflows, and FI outflows, are they going to increase materially as we move towards the last phase of election campaigning, or you don't see any material change from now?
So I must confess, if there's something which is more difficult to predict than stock markets in the short run, it is electoral outcomes. And then these electoral outcomes lead on to short-term gyrations in the stock markets, which are even more unpredictable. So I think it's difficult to hazard a guess on where we are going in terms of election outcomes. The general noise that you hear is that this government deserves a second term, but that's just anecdotal evidence. Obviously, what happens ultimately is going to be decided by the citizens of this country, and it's not for me to predict an electoral outcome. Having said that, let me assure you there are 2 or 3 things that keep me constructive on stock markets in the longer term. I don't know what might happen in the next 6 months, but if you look at the next 2 or 3 years, I think we are definitely on for much better outcomes in terms of stock market or investing outcomes compared to where we are, despite this stupendous run-up, as it were, since January. And not to forget the fabulous 30-odd% run-up that we saw in 2017, calendar 17. And the reason for my optimism is grounded in 2 or 3 structural changes that have happened in the economy. I have alluded to one, which is that we are getting into more and more financialization of savings. So that is going to keep stock market inflows steady. This is one bit. The second thing is that we are becoming more and more of a formalized economy, and GST is just one lever here. So demonet, despite the bulk of the notes coming back, had one salutary effect, and that is reflected in the fact that we've had more than 54 million taxpayers or at least income tax returns filed this year. And many of these income tax returns might be zero tax returns, but they will become progressively over a period of time, they will become taxpayers as well. And more people will keep on entering the tax net, and the formalization of the economy that Aadhaar brings in, that demonetization brought in, that the Jandan accounts bring in, and that the financialization and formalization of the economy forced through GST. So all these were short-term pains, as we can see, and there's tremendous long-term gain coming up out of these short-term pains. So if we are worried about GST inflow, GST collections not really hitting 1 lakh crores a month, 1 trillion rupees a month regularly, I think some of those worries will recede as we move forward with more and more formalization in the economy. And the opportunity to play high-quality managements and high-quality companies in the stock market, especially companies which benefit from formalization of the economy, should that happen at the current momentum, and should that continue with the current momentum, the opportunity to play the market and play investment stories will rise several fold from what it could have been 4 or 5 or 10 years ago. So I am constructive from a longer term perspective on markets. Yes, there are elections in the short term. Yes, there is going to be volatility because of the weaker currency and higher oil prices, and of course global macro political or even trade stability. I think all these will provide opportunities for people to accumulate, and which is why I said I do not foresee a one-way path to 12,000 from here on.
Right, again. So perhaps gyrations are going to remain there, but I think one point which is very important, which our viewers would be listening very carefully, is that financialization of savings, again, if that trend is going up, the domestic inflows actually are going to remain strong, and that is what I think Dipen is highlighting, and that is what something you should be really focusing on for a medium term sort of behavior in terms of markets there. Dipen, let me again now go straight to stock ideas here. And let me actually ask you first on the mid cap and small cap ideas, where as I understand, again, you're bullish on PNC Infra. Help us understand what you like about the company. How's the order book looking in terms of earnings trends also? What's the overall thought process at present on the company?
Right, so it's a difficult time to be able to recommend an infra stock from the mid-cap space, because as you know, EPC or infra companies have taken a heavy beating over the last 6 months. Also the fact that the bulk of the market inflows are getting clustered around large caps has led to a skew in market performance. So what made me recommend PNC Infra? So that's the whole point. People have taken their eyes off this little gem of a company. The reason I feel that way is that not only did they have a blowout fourth quarter performance, which of course got our confidence reinforced in their capabilities, but the big concern around the infra stocks over the last 4 or 5 months is something that needs a closer look. I think if they've gone through re-rating, some of it is obviously because many of these stocks had run up crazily and some kind of sell-off was due to happen. But the larger concern that institutional investors have been expressing to us in our recent interactions has been whether the large run-up in the businesses of these companies, of the EPC or infra companies, is sustainable, and whether there is real longevity to the business which can then justify the 12, 13, 15x kind of multiples that these guys are commanding. Because at the end of the day, they are contractors. And with every regime change in government, you don't know how contractors are going to be treated by the next government. This is one. And two, if the government is spending very aggressively today on infrastructure and rolling out many more kilometers of national highways per day than what it was doing 3 or 4 years ago, is this something that is really going to carry on into the future in a sustainable way so that these guys can deserve these multiples? Now the point is that if you look at PNC Infra's numbers, it is already, quoting for, it already has a book-to-bill ratio, which means the order book today, which is about 14,000 crores, which is which is like 7-8 times of its 1700 crore revenues of last year. And so at least half of that order book is going to kick into action over the current year, which is FY 18-19. And while we might see a little bit of a lull in new order tenders coming out for bidding over the next 2 or 3 months, I think again as we enter December, January and so on, when we enter the fourth quarter, we expect to see a much larger flow of tenders coming in from NHAI. So many of these companies who are already sitting on large order wins are going to see many of those order wins translate into execution phase over the next 6 months, and then as that kind of recedes, we will see a large tender pipe also coming into play. So visibility on the business, which is the biggest concern of investors in terms of longevity for their revenues and their revenue growth, is going to fall off. PNC is a master at execution. They typically earn early completion bonuses. The capital that they need for kicking off their HAM projects is going to be provided by a potential sale of their current BOT assets at a reasonable profit, and also the HAM asset investments are likely to get monetized over a period of time at a multiple to book value. So I think net tidings for this particular company are extremely positive, and we think it's available at a fairly reasonable bargain. I think our SOTP valuation for this company is close to double the current market price. You need to wait a couple of years for that kind of gain to play out. Be warned, there could be volatility in the middle, but we are very constructive on PNC Infra with a target price of 322 rupees a share.
Right, so 322 again, virtually a double again, what again basically the target price is indicating at present. I have to ask you, Dipen, this is PNC Infra again, you've just highlighted, you've given us a rationale why you like it, and now I'm trying to compare it. Now I could have compared with any other company, but I'm just trying to compare it with Dilip Bilkon here. Another company again which owns the equipment like PNC Infra again basically has seen a good stock price correction. Now at present, if I just look at the sort of average analyst estimates, is trading at 13 P again for the FY19 analyst estimates, average estimates here. Very strong order book again. So why PNC Infra? Why not other company, or if you like any other infrastructure company in the same space?
So frankly, the company with the best operating metrics in the space continues to be KNR Construction, and the big reason to love KNR, and we've always been admirers of KNR, the big reason to admire KNR has obviously been their very tight working capital management. And so if you see, KNR has the shortest working capital cycle in the entire industry. I think both PNC and KNR are relatively smaller companies than Dilip Bilkon. So to be able to grow revenues at 20-30% on those bases is less of a challenge compared to what it might be for Dilip, for example. Also the fact that, so again, why not KNR in that case? So it's not that we have a sell on them. We also have a buy with a reasonably high upside for KNR as well. The only reason why I was recommending specifically PNC was that they were a little more battered in the current downturn, and the fact that the uptick might be much more spectacular for them. But yes, we have a strong and conviction buy on KNR as well, and yes, for your information, we have a buy on Dilip Bilkon too.
Right, so very clearly bullish on the sector, but as Dipen just highlighted again, there is a far greater opportunity on PNC Infra at present, because the stock actually hasn't beaten down in the recent mid-cap carnage what actually we have seen across the sectors here. Second stock, Dipen, what is the stock which you like at present, the mid-cap category?
So I wish you would ask me something about the large caps, because that's where all the action is happening. But if you ask me for another stock in the mid cap category, I would look at Symphony. And this is actually a beaten down stock if you look at recent performance. So it's come up some 40-45% from recent highs, and it's still trading at a fairly higher multiple. So Symphony manufactures air coolers and is by far the market leader in the air cooler market. Now remember that we are coming off what has clearly been a disastrous summer for the air cooler market, or the cooling products market as it were, and particularly for air coolers which are impulse purchases, and air cooler sales shoot through the the roof on those few days in summer when you have extreme heat in northern India and western India. That hasn't really happened in the usual way. For a variety of reasons, the weather has been a little more acceptable, I should say, this summer, and they've suffered a crack in stock price, not to mention a crack in revenues and profits. So their first quarter profit almost got wiped out. Now we think that the structural drivers of the story here have not changed at all, and in fact this bad weather pattern affords longer term investors a chance to accumulate the stock. Yes, mid caps are out of flavor. Yes, Symphony is an illiquid stock, and yes, it has posted disastrous first quarter numbers, but the larger thesis is absolutely intact, and this is actually an opportunity. So you have 50% market share in the air cooler industry, where Symphony is by far not just the market leader, but also the price setter, the most innovative player in terms of new product rollout and so on, and has a tremendous franchise with its sales channel despite the crack in sales in this quarter. So they have one of the lowest working capital cycles in the industry. Again, a great reason to buy this stock. And the second thing is that the penetration of air coolers is still not enough in terms of across the country, in terms of the revenue visibility that it creates for us. And of course the move towards formalization in the economy is also going to ensure that many of the unorganized players, the unbranded players or the regional players over a period of the next 2, 5 or 10 years are going to become that much more weakened in terms of the competition that they can offer Symphony, which again bodes very well for pricing power. We haven't seen Symphony resorting to offering large discounts or any such thing, so which tells me that management is very, very focused on maintaining their premium position in the market, not let go of pricing just because seasonally we've seen a bad summer. And I think over the next few quarters, as the channel gets stocked up for the next summer, we will see a better performance for Symphony, although it could take a while before year-on-year numbers look very good. I must point out in this context, of course, that a company with a very strong franchise, when it goes through a difficult time, if you are convinced about management strategy and their capability to come back into the reckoning, then you should back them by buying their stock, and that's exactly what we are recommending for investors to do here.
Well, Dipen, I'd save the last year as the best again for the last, because it again definitely pays for picking a very good contrarian picks, and that too again coming from a very well-known stock picker like you again. So two mid-cap stocks, Symphony and PNC Infra, coming from Dipen again. Symphony in particular, 60-70% again basically is the target again compared to the current market price. That is sort of potential at present. Now large caps again, Dipen, let's talk about those. As I understand, you like ITC, SL Tech. What's the opinion there? And let's first start with ITC, because again consumption has been the flavor, and over the last 2 months again we have seen some re-rating happening for ITC. Are you turning bullish now in terms of tobacco volume growth, and do you think FMCG can finally start firing up? So how are the next 12-24 months looking to you?
Right, so ITC, as you know, is coming off a phase of 2 or 3 years of punitive taxation and hikes, in which volume growth slipped into the negative. Yes, it is in a sinful industry, so to say, a sin industry, if I would rephrase myself here. And yes, it's fashionable for any government to keep on ratcheting up tax rates for this industry, not just to collect more taxes, but to look like a more responsible government. I think much of this is now receding. And the admirable thing about ITC is that even despite this punitive tax, or continuous imposition of higher and higher punitive taxes on its tobacco products, which is cigarettes, where it enjoys a very heavy market share, ITC has actually managed to grow revenues despite falling volumes in cigarettes. So the last 2 or 3 years, ITC has grown cigarette revenues, segment revenues at 8% CAGR despite this adversity. Just compare that with what the rest of the FMCG pack has been achieving. Of course, they are in non-sin categories of the FMCG industry. So this is one great great reason. The second thing is that the illegal cigarette trade is seeing a strong clampdown, as has been the case with a whole lot of illegal trades with this government. So compliance and formalization are rising, and rising dramatically. And it's going to get more and more difficult for people to smuggle in cigarettes or manufacture them illegally within the country and make a living out of that. Remember that just about 11% of all tobacco is consumed through cigarettes in this country, with a very large proportion being consumed as gutka or chewing tobacco. And I think some of that is also changing with the gutka ban playing out in so many states, and the compliance around that ban getting better enforced. So this is the headline reason why we think ITC is worth buying. It's a large nifty stock with a heavy float and a very large percentage in the nifty, and it has relatively underperformed if you look at the last 12 months or 24 months and so on and so forth. But what's more important is that it's now set for a period where irrational taxation hikes will probably ease off over the next few years, and which is going to give it tremendous pricing power. That coupled with the fact with the factors that I mentioned around formalization and the increased consumption of tobacco through cigarettes is likely to keep valuations, which are running today at about 28-29x on F20 basis, which is close to about 60% of the average large cap stock in the FMCG space. It looks to me like the 40%, 45% looks like a very, very unfair discount for a sin category like cigarettes. Obviously there are other drivers, like the hotel segment is going through a cyclical uptick right now, or the FMCG business of ITC, which is now a $1.7 billion business, is probably at the end of its investment phase and is showing very good profit growth here on. So last quarter was an indication where segment profits in the FMCG segment grew at 70-80% year on year. I think everything is coming right for ITC right now after a prolonged period of adversity in the cigarettes business and investment in the FMCG business, and people's eyes are off ITC right now. I think this is a stock that merits a very close look.
Dipen, then in that case, what is the target you're looking for ITC?
So, well, you know, our published target might be 15 or 20% higher than current market price, but I think if you're buying ITC, you need to buy it for a decade and nothing less. So, if you look at 5 years out or something, I wouldn't be surprised if the stock could deliver a 70-80% gain or even double from here. When everything comes together, when everything's firing together for ITC, I think it could be a very, very profitable pick in the large cap space. And I think it's one of the large caps that has kind of underperformed, and it's time for a massive catch up here.
Right, and Dipen, quickly, since I only have now 1 or 2 minutes for you, a word on HCL Tech, why you like the stock, and perhaps what's the target you're seeing on the stock, a relatively undervalued large cap IT stock.
Right, so I'm happy you asked me on HCL Tech and that you've allocated a little bit of time for it. As you know, the IT sector has gone through a tremendous re-rating over the last year and a half. Many stocks are up 2.5 times. Many of the large caps are up anywhere from 40 to 70%. A company like TCS is now, a mega cap. At more than $100 billion of market cap. And so why would I recommend the relatively underperforming HCL Tech at this point of time? So one, the headline reason for IT stocks to do well, especially given their business performance over the last year and the fact that the dollar has strengthened against the rupee, makes all IT stocks worth, of course, remaining invested in. But specifically on HCL Tech, it's coming off, like ITC, as it were, it's coming off a phase of sluggish performance, and that's because it was allocating a relatively large part of its accumulated profits into investing in the IP assets of IBM and DXC, the HP slice out, and many of these investments are slated to play out over the next few quarters. The confidence on its ER&D growth therefore comes from the maturity or the maturing of these opportunities. And remember that ER&D slice, the ER&D slice comprises a lot of discretionary spending by US companies, and with the US economy looking strong, I think a lot of discretionary spending will drive this slice of the business. The second thing which was sluggish about HCL Tech was some kind of a drop in the momentum of its IMS slice. Now HCL Tech was a different company from the rest of the frontline IT companies in India, in the sense that more than 30% of its revenues, or close to 30% of its revenues, used to come from the IMS practice. So that had kind of slowed down, and I think we are seeing very strong deal wins there, and a resurgence in growth coming back on the IMS slice. So and overall at the macro or at the company level, we've seen very strong deal wins kicking in again over the last 1 or 2 quarters, particularly the last quarter. Management commentary looks extremely confident. So I think if you add up all of this and you look at headline valuations which are something like a shade under 14x, and you look at headline valuations which are something like a shade under 14x or so, I think it's the cheapest frontline IT stock, and won't remain this cheap for too long, if my gut feel is right.
Well, Dipen, I like the last line, won't remain as cheap again for too long. Yeah, so that's HCL Tech for you, ITC, HCL Tech, PNC Infra and Symphony again are the 4 picks coming from Dipen here. Dipen, thanks a lot for coming on the show and sharing your insights on the markets and your topics at present in the mid cap and the large cap category. Thanks a lot for that.